When it comes to investing strategies, two of the most popular that come to mind are dividend investing and growth investing. And when it comes to ETFs for both of these strategies, the question that comes up the most is which one gets you rich faster. So let's talk about what dividend ETFs are versus what growth ETFs are. Dividend ETFs are made up of companies that pay out dividends, and dividends are part of a company's earnings that are paid out to its shareholders. Not all companies pay dividends. Some may choose to reinvest profits for growth and expansion, paying off debt, or other reasons. Companies that pay dividends are typically mature and more established companies that are financially solid and have a history of stable earnings and cash flow. This is also why they generally have less volatility compared to more growth-oriented stocks. These dividend ETFs can provide you with consistent income, whether the general market is going lower or higher, and they still provide you with the potential for growth. Other than the opportunity for growth and dividend income, dividend ETFs can differ in their approach and strategy. Some may focus on providing high dividend yields, so they hold companies that pay out high dividends, or some ETFs focus on dividend growth, where companies have a history of growing their dividends every single year. And with some ETFs, it might be a mix of both. Either way, dividends can be a solid stream of income, whether you want the extra income or to cover some bills or to maybe live off that income during your retirement. Growth ETFs, on the other hand, work a bit differently. And these are the type of ETFs that attract investors who want to increase the potential returns of their investment portfolio. Growth ETFs hold stocks that are expected to have above average growth, that are rapidly growing earnings, market share, and expanding their businesses. And unlike the companies that you find in dividend ETFs that pay out larger dividends, these growth companies are focused on reinvesting the profits back into the business. The stocks in growth ETFs are typically found in innovative leaning sectors like technology, communication, healthcare, and consumer discretionary, including popular names like Nvidia, Apple, Microsoft, and Google, just to name a few. And growth ETFs have shown the potential to outperform the overall market, which you can see with the ETF VOO representing the S&P 500. In a bull market like the one we're experiencing now, growth ETFs can provide some great returns. The higher rewards do come with the trade-off, as growth ETFs come with more volatility and larger possible drawdowns during market downturns and recessions. They're also more sensitive to uncertainty in the market, earnings reports, and changes in market sentiment. Because of this, they tend to be better for investors with a longer investing time horizon and a higher tolerance for market fluctuations and risk. Now that you know what these ETFs are about, I want to go through some examples of some great dividend and growth ETFs. Let's kick it off with dividend ETFs first. And for these dividend ETFs, I'm going to be talking about two different types, one being focused on dividend yields, and the other one on dividend growth. First up is going to be VYM, the Vanguard High Dividend Yield ETF. VYM tracks the FTSE High Dividend Yield Index, which includes companies that offer stability and high dividend yields. This ETF has a dividend yield of 2.5% that's paid out quarterly, and it has an expense ratio of 0.06%, costing you $6 for every $10,000 invested. When it comes to the portfolio of VYM, this ETF has 566 holdings in total, and it has its top holdings in names like Broadcom, JP Morgan Chase, Walmart, and others. And the top sectors that make it up include financials, industrials, technology, and healthcare. So a nice spread of stocks over a variety of different sectors. And for the returns, VYM has had 5-year annual returns of about 15% and 10-year returns of nearly 12% annually. Some nice appreciation combined with the dividend income that it provides. The next dividend ETF is dgro, the iShares Core Dividend Growth ETF. dgro tracks the Morningstar US Dividend Growth Index, which contains stocks that have a history of consistently growing their dividends. This fund comes with a dividend yield of 2%, which is paid out quarterly, and it has an expense ratio of 0.08%, costing you $8 for every $10,000 invested. For dgro's portfolio, it has 398 holdings in total, with top holdings in companies like Apple, Johnson & Johnson, Microsoft, Exxon, and more. And the sectors that is primarily exposed to are financials, technology, and healthcare. This fund also has a great variety of stocks with a mix of growth and value companies. For the returns, dgro has had 5-year annual returns of about 14% and 10-year returns of about 13.5% annually. While dividend ETFs are able to provide you with consistent income, they also have some pretty solid growth potential. Here's a list of some other solid dividend ETFs you could come back to and take a look at later on. Shifting over to some growth ETFs, the first one is going to be schg, the Charles Schwab US Large Cap Growth ETF. schg tracks the Dow Jones US Large Cap Growth Total Stock Market Index, so specifically large cap growth companies. This fund has a dividend yield of just 0.35%, which is low compared to the dividend ETFs, but you have to remember growth companies are what make up this fund. As for the fees, it has a nice low expense ratio of only 0.04%, costing $4 for every 10K invested. As for schg's portfolio, this ETF contains 197 holdings in total, with its top holdings in growth names like Nvidia, Microsoft, Tesla, Meta, and more. For the sectors, it's mostly going to be technology, making up about half, then communication and consumer discretionary. No surprise here that technology is going to be the main driver for this fund. Getting to the returns, schg has had 5-year annual returns of 19.5% and 10-year returns of nearly 19% annually. Growth has had some amazing performance over these past years. And the second growth ETF that I'd like to mention is QQQM, the Invesco NASDAQ 100 ETF. QQQM invests in U.S. large cap growth stocks in the NASDAQ 100 index, which is an index that includes the largest 100 non-financial companies that are listed on the NASDAQ. This fund, of course, isn't for the dividends, but it has a dividend yield of 0.48% that's paid out quarterly. For the cost, it has an expense ratio of 0.15%, making it a little bit higher than the others that I mentioned. Shifting to the portfolio of QQQM, this fund holds 108 holdings in total, and the top companies of this fund are Nvidia, Apple, Broadcom, Amazon, and a few others. For the sector exposure, technology makes up a pretty big chunk of the total portfolio. Then we have consumer discretionary, and the remaining spread in a few other sectors. The best part of QQQM is its returns, but since it's only been around since October 2020, I'll be using its bigger sibling QQQ for the 10-year returns. They're almost exactly the same, just QQQ has a higher expense ratio and more trading volume and liquidity, making it the choice for traders. So for QQQM, it's had 5-year annual returns of just over 19%, and for the 10-year returns, QQQ had provided 20% annually. So it's really been flying. Growth ETFs can be a strong addition to a balanced portfolio, helping to boost the potential for even more appreciation. Here's a list of some other growth ETFs and tech-focused ETFs that you can come back to and check out later on. Next, let's get into the pros and cons of both dividend ETFs and growth ETFs. Let's kick it off with the pros or advantages for each. For dividend ETFs, the first benefit is the passive income they provide. Dividend payments provide passive income to investors, and this cash flow can help build financial security. By that I mean the income from dividends can help to cover some of your expenses, or maybe at some point cover all of your expenses without needing to touch the shares of your ETF. Next would be lower volatility and risk. Dividend ETFs tend to be high quality and well-established companies that have strong financial history and the sense of growing earnings and growing their sales and having free cash flow. These are the characteristics of companies that manage to grow their dividends and to continue to provide dividends. The next benefit is snowballing or compounding returns with DRIP. DRIP stands for Dividend Reinvestment Plan, and it's simple. It's just the process of automatically reinvesting your dividend income back into your investments. So you're automatically buying more shares with that income. The power of this is that you're reinvesting and buying more shares, and your future dividends are going to be higher since the total amount of shares that you have will be growing. This compounding effect is known as the dividend snowball effect. Now let's talk about the pros of growth ETFs. First is that it gives you exposure to emerging trends and innovation. Growth ETFs hold companies that are in cutting-edge industries and are driving the future of technology, renewable energy, healthcare, and more. The leading companies these days being in industries that are in and around artificial intelligence, electric vehicles, energy generation and storage, and more. The next and most attractive benefit is the high returns from growth stocks. The best part about growth ETFs is that they have the potential to provide returns that are above the market average due to the expected future growth potential of the companies that make up the fund. There are many great options for high-performing growth ETFs, and complementing them with other funds can amplify the returns of a portfolio. And the last benefit is that there are less tax implications than dividend ETFs. With growth ETFs, you're building your wealth through long-term capital appreciation and the power of compounding at a higher growth rate. Unlike with dividend ETFs, where you can still have some appreciation, but you're also receiving that dividend income. And you will be taxed on this income, and the tax rate will depend on what it's classified as. Those were the pros for these ETFs, but now let's get into the cons. The first con for dividend ETFs is paying taxes on the dividend income. Now, of course, whether you pay taxes or not will first depend on if the dividend ETF is in a non-taxable account or a taxable account like a brokerage account. In a taxable account, you would have to pay at your normal income tax rate if you're receiving ordinary dividends or non-qualified dividends, which could come from fixed income ETFs, BDCs, or REIT ETFs. And if it's a qualified dividend, then you'd be paying long-term capital gains tax, which is taxed at lower rates from 0 to 20%. The next con is that dividend ETFs will underperform growth. This isn't too surprising since dividend stocks tend to be more established and stable companies, while growth companies are focused on reinvesting and expanding their businesses. For this reason, there's much more upside potential in growth companies for increasing their sales, profits, and earnings, resulting in a larger runway for the stock price to increase. This third one is a big one, and that's chasing high dividend yields. This is much more common in recent years, but what I mean by high dividend yields are yields that are beyond 10, 15, or 25% or more. These types of ETFs are likely going to be using options to generate that high income. They could also be using leverage, synthetic exposure, or incorporating a variety of other different strategies to generate that high income. When you're seeing those really high yields, it's easy to be pulled in when you aren't aware of the higher risks that may come with it, or not even understanding how these type of funds truly work. Now that you know some of the good and bad that comes with these funds, how much of your portfolio should be in growth or dividend ETFs? First off, how much you should allocate for either one of these ETFs should really depend on your investing preferences and risk tolerance, since there isn't a general fixed amount to have for your portfolio. If you're a much more conservative and risk-averse investor, then it's better to have a portfolio of more dividend and value-leaning ETFs. And if you're open to more risk, which invites more volatility, but a higher growth potential, a portfolio that's more growth leaning could be a better choice for you. Age can play into this, since the younger you are, the longer your investing time horizon is, which means you can tolerate more risk. Being younger means there's more time to recover from losses, and that can allow you to focus on investments that have more volatility and higher growth potential, like growth and tech-focused ETFs. You'll also have more time for investments to grow and compound over time. But if you're on the other end of the investing timeline, maybe 10 or 15 years or less away from retirement, then you might want a lower portion of growth in your portfolio. If you're close to retiring, it's going to be important to have much more stability and to preserve your wealth. So more conservative assets and investments are going to be a safer option, along with the bonus of having the additional sources of income, like the dividend income that you'd receive from dividend ETFs. The good news is that you can make adjustments to your allocations throughout your lifetime as you get older, slowly shifting from a more growth-oriented portfolio to a more stable and income-providing portfolio. So which one of these ETFs will make you the most money? Looking at things through a black and white lens, I'd have to say that growth ETFs can provide more potential in the long run. But just as it's important to grow and build your wealth, it's also just as important to ensure that you have a strategy in place to maintain the wealth that you created later in your life. For this reason, it's important to have diversification in your portfolio. You never know what could be going on in the market at any given time in the future, and the last place that you'd want to be is at the mercy of the market because you have too much concentration in a sector or industry, putting your retirement at risk. Having a diversified portfolio could really go a long way, and if you want to learn about creating a solid 4 ETF portfolio for long-term investing, then watch this video here. Or if you want to keep it simple and see the 1 ETF portfolio to buy and hold forever, then check out this video here. Be sure to hit that like button and subscribe for more content. Keep on investing, and I'll see you soon.